In this presentation, we will take a look at internal control over financial reporting, otherwise known as ICFR. Internal control over financial reporting, ICFR, according to Section 404 of the Sarbanes-Oxley Act, requires management of publicly traded companies to issue a report that accepts responsibility for establishing and maintaining adequate internal control over financial reporting, ICFR, internal control over financial reporting, and assert whether ICFR is effective as of the end of the fiscal year. So you can see part of the emphasis in the Sarbanes-Oxley Act is going to be emphasizing those internal controls. It is thought that internal controls are going to be a crucial part of making sure that the financial statements are presented fairly. And so basically it's going to be in a more formalized setting. Most, of course, the large companies put in internal controls anyways, of course, because if you're a publicly traded company, you would need sufficient internal controls in order to safeguard against a large type of misstatement that could potentially happen. So in order to lower that risk, companies would generally put in internal controls in any case. But the Section 404 of the Sarbanes-Oxley Act will more formalizely make it a requirement to have the internal controls in place and also make sure that the management is stating that they are responsible for those internal controls. So let's read through that one more time. Section 404 Sarbanes-Oxley Act requires management of publicly traded companies to issue a report. So they're going to issue the report accepting responsibility for establishing and maintaining adequate internal controls. So they're basically saying, hey, I'm responsible for the internal controls being set up and to maintain those internal controls over financial reporting. That's the ICFR, which is going to be reported to here, internal control over financial reporting, and assert whether the ICFR is effective as of the end of the fiscal year. Management must comply with the requirements below for the external auditor to complete the audit of the internal control over financial reporting, the ICFR. So management has to basically comply with these, and then of course the auditor as well needs to have the management to comply with these in order to complete their audit. Remember, this is for publicly traded companies. Accept responsibility for the effectiveness of the entity's ICFR, internal control over financial reporting. Evaluate the effectiveness of the entity's ICFR, internal control over financial reporting, using suitable control criteria. Support the evaluation with sufficient evidence, including documentation, and present a written assessment regarding the effectiveness of the entity's ICFR, internal control over financial reporting, as of the end of the entity's most recent fiscal year. Responsibilities of the auditor under Section 404 and AS5. The entity's independent auditor must audit and report on the effectiveness of ICFR. The auditor is required to conduct an integrated audit of the entity's ICFR and financial statements. So again, note, as we've been discussing the internal controls and the process of the audit, it makes sense for the auditor to put more reliance on the internal controls because we're going to need to do so in order to limit the substantive testing. So really, this section is doing what you would think at this point in time we have known in terms of best practices to be the common sense type of thing to do. If you're in a publicly traded company, you're going to basically take a look at the internal control and make sure that you're testing those internal controls. That has been more formalized here. And you can think about the history of setting up the audits, and as companies have grown, as we put regulations in place, this is something that we'd have to basically pick up and learn in terms of what's going to be the best practices with regards to the auditing, how to implement the auditing, and basically at this point in time with the size of large publicly traded companies, it's come to the conclusion that we do need to rely on those controls and we put that formally into the law. But again, it's probably at this point in time known and it should be a best practice as well. So let's go through this one more time. Responsibilities of the auditor under Section 404 and AS5. The entity's independent auditor must audit and report on the effectiveness of the ICFR. The auditor is required to conduct an integrated audit of the entity's ICFR and its financial statements. ICFR is defined as a process designed to provide reasonable assurance regarding the reliability of financial reporting and the preparation of financial statements in accordance with GAAP, generally accepted accounting principles. Controls include procedures that pertain to the maintenance of records that accurately and fairly reflect the transactions and disposition of the assets of the company, provide reasonable assurance that transactions are properly authorized and recorded in accordance with generally accepted accounting principles, GAAP, provide reasonable assurance regarding prevention or timely detection of unauthorized acquisition, use, or disposition of the company's assets.